Everybody, welcome to the morning market briefing. It's Wednesday, last day of August 2022. Feel like in some ways, Ben, the year's kind of flying by. It's been certainly a grind. We had a former intern in yesterday, and we're talking about just market volatility and the challenges there. So we're continuing to kind of just pick through and get a better view on where we're headed. Interesting on the economic data front, it does seem like we've seen some improvement. That's favorable. The downside to that is specifically as it relates to equity markets probably means that the Fed is going to be more hawkish, be a little bit more aggressive. We saw job openings rise to 11.24 million in July, an increase of about 200,000. The estimate was for that number to actually fall. We came in close to $1 million higher than what was expected. We've seen the Conference Board Consumer Confidence Index rise from 95 to 103. The expectation was 98. We just got the ADP employment report in, which is an interesting data point. Looks like we added 132,000 jobs. Not a good number there, but I also think we have questions about the accuracy sometimes of the ADP report as it relates to the actual employment report, which we'll get Friday. How are you kind of digesting all this stuff?
Yeah, I think that overall, I think we'll talk a little bit about consumer spending when we get to Visa in a little bit. But in terms of the data that we got yesterday, definitely better than expected, which isn't a good thing. It means there's more demand in the economy and less supply. So if we're looking at the job openings, 10% higher than expected, that's significant. That's substantial. Consumer confidence rising significantly. Expectations when you're talking about the consumer rose significantly from 65.6 in July to 75.1 in August. When people are more confident, they spend more freely, which leads to more inflation. ADP employment, I'm just not reading into it at all.
It changed the algorithm and everything.
I think it's a total non-event. They actually took the month of July off because they were messing about with the methodology because they were so bad. Well, they come out with this new number and they report 132,000 today. The estimate was 300. But last month, then they kind of reverse engineered what it would have been last month and they had it at 270. The official number was at 530. So if you say they undershoot again by 260, then we're outperforming expectations substantially. So overall, and then what ADP actually did as well this time, they actually broke out pay for people and they said job stayers are getting 7.6% more per year. Job switchers are getting 16.1%. Large companies, you're up 8.3. Small companies, you're a little bit behind at 5.4. In terms of sectors, leisure workers are getting 12.1% more. But again, if you look at job switchers versus job stayers, you're talking about 9%, 8.5% premium, 16.1% year-over-year change versus 7.6%. That does not bode well for inflation. You're not going to have, if people are continuing to be incentivized to leave because they can make more money, that is only going to pressure inflation higher, which means the Fed needs to step on the brake even harder. So I think that the Fed very much is disappointed with the data over the last couple of days. They want a slower economy, and that's not what we're seeing right now.
Yeah, anecdotally, we had a former intern in yesterday, Christian. Some of you guys may remember him from a couple of years back. He's graduating from Georgia Tech in December, and we were just talking about the internship program that we run here with folks, talking about hiring. We've got a new hire starting tomorrow on the investment committee. Christian knew him from back when he was at Tech. He knew some of our current interns, and we were just talking about kind of the market, even in kind of our cross section of the economy. And he was like, man, it's just such a good job market still. Christian had done an internship up in New York, got a great job offer out of that, said he basically felt pressured to take it, went ahead and took it, but he's also, who knows what happens. So I don't think we're seeing the pronounced slowdown that I would have expected by this point.
Yeah, we're definitely seeing in pockets. We're seeing in Snapchat. Snap is laying off 20% of the workforce with its Maps division and third-party application division. They're focused on more growing the user base and improving its ad tracking, but they're laying off a lot of workers. They're down 7% this morning. But it really does seem concentrated in the tech landscape. And you do wonder to an extent, does the tech world know something that the rest of the world doesn't? And I think to an extent that's true. I think that consumer is getting squeezed, especially if we look at Not so much the broad economic data, but if you stratify it out by income group, I think that you're seeing a little bit more differences in terms of that. But in terms of the large corporate jobs that serve large corporate clients, those continue to perform well. The ones that are selling discretionary products, not so well.
Yeah, it's interesting. I mean, we're kind of in this weird spot where if the ultimate trajectory is what we think it is going to be, then some of these more growth oriented tech companies actually seem to be the more responsible parties at this point by being out ahead of it. I'm not, patting them on the back for laying off workforce by any means, but they're being proactive at a minimum, which is something that I do think should be noted. On the inflation side, Eurozone CPI came in at 9.1%, up from 8.9%. The expectation was for an even 9. Core inflation came at 4.3, up from an expectation of 4.1. But we are seeing some nuance kind of on a nation by nation basis. How would you kind of reconcile the themes we're seeing so far in Europe?
Yeah, I think the reopening has a play, and I confess I haven't studied this in tremendous detail. We have seen more acceleration in Italy, for instance, than we have in France, but inflation broadly is still elevated. And what's interesting about the Eurozone is that you saw a significant acceleration from 4% to 4.3% on the core. ECB is going to hike by 75 basis points, I think, next week when they meet. So that'll be the big event for next week. That'll be something that we're watching very closely, along with, I think we get our CPI report the following week. So we'll get ECB next week, our CPI report the following week. It's going to be a lot of data coming in, but I do think the ECB is going to raise by 75 basis points. The interesting thing on the Eurozone piece is that with the core inflation peak rising, you can't just blame it all on natural gas prices. Gazprom is they're talking crazy talk in terms of where gas prices could go in Europe. I mean, right now you're at $69 per 1,000 cubic feet. They're talking about it going to $4,000 per 1,000 cubic feet in this winter. That's the Gazprom CEO. So he's saying it's primarily the result of Western sanctions. So I mean, that's just crazy talk. I don't think it happens. They'd have to basically shut off all gas right now if you're Gazprom. But that's
just
beside
a nice
the point.
60% or 60x increase.
Yeah. But having said all that, the core inflation in Europe is also accelerating. That's what the ECB will be concerned about. That's why they're going to hike by 75 basis points next week.
We do have data from Visa as a bit of a read through on the strength of the consumer. What's interesting is looking at just volume across both the credit card and the debit card space from July to August, looking at year over year trends, seeing stability and even a slight uptick. In August, US payment volume was up 11% in total. Credit payments up 17%, debit up 7%, both of those slight increases over what we saw in July. But we are seeing a little bit of softening in the e-commerce, so transactions in which the card's not present, online shopping, things like that. It's steadied out, it seemed a bit in June and July, but seeing a little bit of a decline in August. So interesting there, Ben. Are you surprised by that piece of the equation at all?
Not really. It kind of fits with everything else we've been talking about so far in that terms of the consumer is actually spending because they're more confident now. They may be incurring more credit card debt. They may be tapping more into their savings, but they're spending more. And I do think that is interesting. It is also interesting that they're spending less online and by contrast, more in person, kind of a renormalization of the consumer spending pattern. So we'll see what happens with this. This will be an interesting space to watch. I continue to look for cracks in the spending narrative, but Visa so far is not seeing that.
Looking at some more company specific data, HP down 6%, having some issues on the personal computing side. Best Buy actually closed up 2% yesterday, had really been aggressive in warning about some sales challenges that they were seeing. Chewy down 11%, Bed Bath & Beyond down 15%. This cross-section of really consumer-facing businesses having some trouble. I mean, Best Buy, I guess, relatively speaking, at least on an intraday basis, weathered the storm better than others. But what are you seeing kind of thematically?
Yeah, I think that this is a case of normalization from COVID, less discretionary spending. And I think that those are the two main themes that I would take away from this. So for HP, for example, notebook units were down 32% over last year. And Andrew and I were in a meeting, which is why we weren't on the call yesterday. But we were talking to someone who does a lot of work with schools here in Georgia. And he was talking about how they were just giving away laptop computers for a lot of these people who didn't have access to, who just maybe had one phone for the family. And we're seeing a normalization there. We're seeing that consumer softness continue and actually increase according to HP throughout the quarter. Best Buy had previously warned, they're saying that people are still buying mobile phones. People are still buying the game system they want, maybe in a little bit lower volume, but we are seeing some trade down in TVs. So where the brand isn't really concerned, or where the hardware is less differentiated, people are going to trade down from your fancy Samsung TV to maybe your Vizio TV, something like that. Chewy, which provides a lot of pet food, pet health supplies, they said that they really brought out and highlighted the difference between this non-discretionary and discretionary spending. And they say, and I quote, "Demand remains durable in non-discretionary recurring revenue categories like core food and pharmacy, while demand in more discretionary categories like hard goods and treats reflect the impact of inflation on consumer spending patterns." That's what Chewy's seeing. And then finally, Bed Bath & Beyond. It was down 15%. Now I think it's down 25% or something like that. Bed Bath & Beyond is just a disaster. They were actually up earlier this morning ahead of this big strategic update that they're coming out with as we speak. And then they filed a securities shelf, which is basically an offering, a potential offering to issue stock.
Yeah,
which
down 31% right
down
now.
31, which I actually think is a step in the right direction. They need to raise capital or they will not exist. And I would much rather do it when the stock is $10 after a short squeeze rally than when the stock is $4. However, it will probably end up in a lot of meme stockholders losing a lot of money. Basically, Bed Bath & Beyond is just going to capitalize on that. But they're taking a 20% reduction in corporate employees. They're reducing sales general expenses by 250 million, reducing CapEx by about 40%. They're closing 150 underperforming stores, and they expect sales to be down 20% for the year. So not so good in Bed Bath & Beyond land. They're trying to right size the business. It's a little bit of a race against time. They're going to use an equity offering to try to bridge the gap. One, they need to bridge the gap. Two, they need to find a CEO who can turn this around. It's a monumental task in front of the company, one that I don't think they'll make it through, but they're giving it the college try.
Yeah, and the meme stock thing it's just wild. I mean, it's a stock that's down 45% from what its high was yesterday. And yet it's still trading at a relatively elevated price relative to where it probably should be. But 52-week high of $30, it's at $8.30 right now. So not all that beautiful, but yeah, I think that's the right move for them. We'll wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great day, and we will talk to you on September 1st.